Hi, I'm David Stein of Money for the Rest of Us, and in this video I answer the question, why do stocks go up in price? Well, of course stocks go up in price because investors are willing to pay more, but why? What is changing in terms of the underlying workings of the stock market that an investor would pay more? Well, to understand that, we have to look at what is the intrinsic value, the inherent value of the stock. And an intrinsic value of a stock is the present value, the value in today's dollars of the future dividend payments of that stock. Companies pay out a portion of their profits in terms of a dividend that goes to the shareholders. Now, some companies don't pay out a dividend, but eventually they will. And so the present value, the price in today's dollars, is based on that future cash flow. Now, investors have a required rate of return for a given investment. And so when we look at the present value, the value of this future cash flow in today's dollar, we need that required rate of return, which is also called the discount rate. For example, $106 today, if we have a 6% required rate of return, is worth $100 in today's dollar. So $106 a year from now is worth $100 in today's dollars. The required rate of return for the investor is 6%. They would be indifferent between receiving $100 today and $106 a year from now. But if their required rate of return was 7%, $106 a year from now, the present value today with that 7% required rate of return is $99.07. And so the value, that intrinsic value, that cash flow, changes as the required rate of return changes. And that's one of the first things that drives the stock market. Investors' required rate of return, which is also called the company's cost of capital, the cost of their equity capital. And a company has a cost of debt capital, how much they pay to borrow money, and then they have a cost of equity capital. What do their investors expect? And together they form what's known as the cost of capital for a company. A company, a corporation, their job is to pursue projects that generate a return greater than that cost of capital. And if they do, they add value and the stock will go up over time. But a stock will go up in price as an investor's required rate of return shifts. If they require a higher rate of return, going from 6 to 7%, then the stock will fall in price. But if they require a lower rate of return, if they're willing to take a lower rate of return, then the stock price will go up. Now, the other thing that drives the stock price, whether it will go up or not, is if investors believe that future cash flow will be higher, that the company will grow earnings faster than what they previously thought. And because there'll be more cash flow in the future, even if the discount rate stays the same, the present value or the intrinsic value of the stock will go up. So that's why stocks change in price. The perception of what the cash flow will be and what that's worth in today's dollars, and the required rate of return from investors. Now, it's very, very difficult to figure out what a future cash flow for a company will be, really to infinity. Investors are always sort of trying to figure that out, and it's difficult to do. In episode 236 of my podcast, I talk about how investors go about that. And one of the things that they do is they use heuristics, rules of thumb, to estimate this future cash flow. And they also use story or narrative to justify what they think will happen to a particular company. And as those expectations shift, that can also lead to volatility in the stock market. So hey, that's why stocks go up and down in price. If you have any questions, you can leave those in the comments below. Thanks.